Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The high-tech exchanges hit record highs, but the Dow did not. Ross will have the story behind that. Veteran retired BC broker Victor Adair gives us his take on inflation, the fear of missing out, the U.S. and Canadian dollars, gold, and crude. Author of several books on the economy, including The Money Bubble, John Rubino, chats about the boom in commodity prices, interest rates, the U.S. housing bubble, and the effects of the labor shortage. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Always a pleasure, Jim.
Ross, we saw a few records set in New York, but pretty mixed.
Pretty mixed category. Actually, if you take a look at the advanced decline line, it peaked the better part of week and a half, 2 weeks ago, and the number of items, the number of indices that have managed to move to new highs is just getting fewer and fewer. The big headline stocks, the Microsofts of this world, the Amazons and Apples, which really have a big effect in terms of the indice values because they're capitalization-weighted indices, they are really not telling the true story of what's going on. As of Friday, we had the third Hindenburg in a row. That's when you have such a disparity that over 2% of the stocks on the NYSE are making new 52-week highs, and at the same time, more than 2% are making 52-week lows. And that's when you've got a rising trend. You're above 50 days earlier. You've got McClellan oscillator into a downtrend. And typically, once you get that type of divergence happening, your market becomes quite vulnerable. So at this point, we are in the early stages, probably the first 20% of the seasonal uptrend, and markets are probably going to see a bit of a correction here. There are some indices. You take a look at like the semiconductors, or you take a look at technology, the XLK. Consumer discretionary, the XLY, they are still screaming along on the upside, but other indices are just not having that same strength. And when you look internally and you see the advanced decline lines having trouble that they're doing right now, clearly, unless you as an investor are in the broad indices where that capitalization weighting works for you, if you're out there trying to pick off individual stocks, you've really got to be very, very careful these days. So the optimum would be that in this seasonal uptrend, you want to still wait for good corrections to be a buyer. And I think patience between here and the middle of December is prudent. There should be something in the way of a correction that one can look at. And, when we look back historically, between the early part of November into the latter part of December, the odds of there being one or two decent pullbacks that can present decent buying opportunities really have been there on a fairly consistent basis. So wait it out and see what happens. A week ago we had the Russell 2000, which had been consolidating since February. It made a really clear breakout on the upside. It has now come back to test its breakout level. So we'll be watching to see if it can have how well it bounces off this support area. What we would have a concern about is if the rally off here doesn't manage to put in a new high and then starts to roll again, you could look at that Russell maybe getting right back down to the lows we saw a month and a half ago. So something to be wary of out there. Markets don't go in one direction indefinitely, so be ready for one of those corrections.
What's going on in crude?
Pretty big action over in the crude oil market, down as of the end of the week, under 76. You've got release of the strategic reserves coming out. The Chinese have been releasing their reserves, as it turns out, for many, many months now. U.S. will be getting around to it. The oil market at this point, I would say that the failure to hold around that $80 mark probably ends up testing more something towards the low 70s before this correction's over. And what we'll look for is some good oversold readings. We had one back in the third week of August when we were down at $62. We'll look to see if we get the same type of reading that we can buy into on this break. Within the energy complex, natural gas has come off its highs as well. We were thinking that you could end up with a decent oversold level if that was to happen before the middle of December, because this is a seasonal period where you usually get a first good run into October, November, and then if you have a decent correction but happens early enough, then you can get a second rally that'll carry you into January. So at this point, we're around $5 on nat gas. Didn't sell off hard enough in the first couple of weeks of this month. If it does have a number of back-to-back days on the downside, could be looking at something maybe in the 450 range as a potential buy. We've got that on the list of our watch list right now. Because that would present a decent opportunity.
What's happening with the U.S. and Canadian dollars?
Okay, so Canadian dollar coming off with commodities. As far as I can see here, we're at 79 cents, basically down from 81 and a quarter, and until you get a bottom, as far as I'm concerned, in the energies, I think the Canadian will stay under some pressure here. U.S. dollar has been nicely trending up, and we're looking at 69 on the index right now. The breakout was the original one was back at 93.5. The second one came at 94.60. So this is a nice uptrend, and the weekly charts are starting to look a little overextended right now, but the trend is clearly up. Now, gold and silver, up until the middle of this week, they were moving up with the U.S. dollar, and we've been doing this for a couple of weeks now. That's a rarer item. You've got that maybe 24 times since 1970 that the dollar and the precious metals move higher together. But once the metals start to deviate from that, as they have at the tail end of this week, then you look for a correction. In gold, the 50-day moving average would be a good support area. That's probably going to be, by the time it's rising and the gold price is declining, you probably find that around 1810. And silver right now, we want to find support around 2460.
Bitcoin, is there action there?
Yeah, this is another one that we've been seeing this rollover of so many items, and here we've got just under 58,000 with Bitcoin, double top up at the 68,000 level. Good support, probably not much under where we are right now. I would say probably around 56,000.
Ross, thank you so much for chatting with us.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at Charts by Ross. Coming up, Victor Adair next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Victor Adair, just retired from nearly 50 years of being in the brokerage business in BC. He's speaking to us from Vancouver Island. Welcome back to the show, Victor.
Jim, it's always a pleasure to talk with you. Thank you.
Victor, the major markets seem to be hitting all-time highs, but are they just being fed by just a few big fat stocks at the top with mid-caps and smaller ones flat to down? And what do you see happening in the market right now?
Well, let's take a big picture look at it. You know, the American stock market is by far and away the strongest stock market of the developed countries around the world. And that is really due almost entirely to the technology sector, and within that, you know, a handful of the really big cap tech stocks. That's just made all of the difference. And then even within the American market, for instance, the Dow Jones from last week's highs to this week's lows fell about 1,000 points, maybe not quite. You know, 2 consecutive weeks lower. Same thing with the small cap indices. They're both, you know, up 2 weeks ago and then have been down the last 2 weeks. Meanwhile, the NASDAQ and the S&P, which are more weighted with these high, big cap tech stocks, are making new all-time highs. So the market breadth is that a lot of stocks aren't going up along with these champions, but the champions are doing so well that it's sort of like pulling the whole market up with it. Now, there is a thing where we have a seasonal trend in the stock market. I know a lot of people are aware of this and pay attention to it, but you go back over the past 20 years and sort of average out the prices, the market usually rises, you know, the last 3 weeks, 3 months, I should say, of the year, and then the first month or two of next year. So there's a seasonal trend that's helping the market go higher. We've also seen this year massive capital flows from retail come into the market. And I'm going to have to do this sort of by the seat of my pants, but I'm going to say roughly speaking, we've had more retail money come into the stock market this year than the last 10 years put together. It's that big. We have corporate buybacks that are huge, that are supporting the market. There's the FOMO thing, you know, the fear of missing out. I mean, God help you if your neighbor's buying himself a new Lamborghini or something like that and you're still driving a Volkswagen, you know. So people don't want to miss out on that. And then the other acronym, TINA, you know, there really isn't an alternative in a lot of people's eyes to being in the stock market. I mean, for me, I'd automatically think, well, you know, real estate looks pretty good and you can use a lot more leverage in real estate if that's your thing. But I guess we've got a situation here where when a market's going up, it keeps going up until it stops going up. And I'm not meaning to be silly about that. I guess the old lingo would be that in this environment, momentum trumps valuation. There's just no comparison. So we're in a bull market in stocks. I think in my old school way of looking at things, I think the market is really overvalued. Well, of course it is, but you know, those are using metrics that are not really timing tools. Valuation has never been a timing tool, and the market will keep going up until it doesn't. I think people, because it's such a low interest rate world, people who should be savers, you know, should maybe just have their money tucked in a bank account or a GIC or with your local credit union or whatever, are saying, gosh, you know, I'm losing my shirt by doing that. I've got to go and take more risk. And I'm hearing from everybody and his dog that the stock market just keeps going up. So, you know, I'll come in and buy stocks. So that's kind of where we are. That's what I think about it. I've been kind of chipping away, taking some short positions every once in a while. Now, I don't go short just because I think the market's overvalued. I will have a view that I think the market's overvalued, but I need to see some kind of technical action that shows me that maybe the market's made a top and it's vulnerable to sliding lower, and I'll take a position. But those are very short-term trades that I take, and I have really like rock solid risk control on those trades just in case I'm wrong. Anyway, that's kind of that's the way I look at the stock market these days.
Inflation, the front page story, the official U.S. inflation rate, 6.3%. That doesn't include energy, housing, or taxes. So 6.3%. The last time we saw inflation like this, Victor, I remember because I just got into the workforce, was 1975. Prime Minister Pierre Trudeau brought in wage and price controls, which did keep wages down, but certainly didn't control prices. And by 1981, the Canadian savings bond paid 21%. Now, with the situation right now, which seems much like 1975 to 81, can disco be far behind? Anyway, with many people saying the central banks need to raise interest rates, what do you think about that?
Well, it depends on your time frame. And let's start with the guy who really matters, and that's the head of the Federal Reserve, Chairman Powell. He's been sticking to his guns that inflation is this run-up that we've seen in inflation, and there's all kinds of ways of measuring it, but let's just stay generalized. He's saying it's transitory. Now, he is allowing that it's got a little hotter than he thought, and it's been lasting a little longer than he thought, but he's still of the view that it's transitory. And there's another number of reasons to think that. But clearly, the public doesn't agree. We just had the University of Michigan Consumer Sentiment Survey, and it's lower than it was at the lows of the COVID crisis in March of last year when everybody was worried that, a pandemic was going to sweep the world. And the reason that consumer sentiment is so low is because consumers, when they're asked, see that this rising inflation is really a problem for them when it comes to buying things. Everything costs more money. And they don't see that somebody's got a plan in place that's going to work to end this. Anyway, now on your time frame, you mentioned that the inflation seems to be a front page story. For me, when something gets on the front page, I want to fade it. When it's on page 16, working its way toward the front page, then I want to be jumping on the trade. I think on a very short-term basis, the heavy breathing about inflation going to the moon got overdone. And I'm willing to, and I have been, making some, again, short-term trades against that. It could be that, this time next year we'll be surging along with a big number in inflation. And, I'll be trading the markets different. Two of the things that I really am going to pay attention to, because I can see why a lot of the things that have caused the inflation could be transitory. Two of the things that'll make a difference will be wages and rents. When you say they don't include housing in it, they do have a thing called a shelter equivalent or something to that effect, but so far it hasn't gone up as much as I think it will, because real estate prices have gone up as much as they have, and eventually if people are renting out a house, that's going to show up. And we're seeing certainly some wage pressure. We had 10,000 people in the United States on strike against the John Deere tractor company, and they all got a pretty handsome pay package when they settled their strike. So we may see that, and it may be that we will see, let's say that we will see labor, have some power to negotiate. Then that's something we haven't seen really, since the 70s. Or it may be that we're just going to see another wave of automation, and a lot of people that are at the, low skill level on the job scale, will remain unemployed. Anyway, inflation, there's a number of different ways to measure it, but for me, the core of inflation is when the purchasing power of your currency declines. It takes more dollars or pesos or what have you to buy some stuff. And I think people are really experiencing that. I know I was in the local grocery store the other day, and I was looking at the meat counter, and I thought, holy mackerel, look at that tenderloin steak, the high-end stuff. It's $50 a pound. I couldn't believe it. Anyway, we have this inflation, and because we use the inflation rate and subtract that from bond yields to get what we call real interest rates. In other words, let's say the inflation rate is 6% and the yield on your bond is 4%. Then real interest rates are negative 2%. I'm telling you that for most of our listeners here, real interest rates right now are the most deeply negative they have been in our lifetime. Again, people don't need to do all the math or understand all the academics behind that. They can just feel that. That's why those consumers in the consumer report, this consumer sentiment survey, were feeling bad. They can tell that their purchasing power of their currency is going down, and they're going to go seek other alternatives, what I call reaching for yield. So the inflation is really important. But you got to look at the causes. You got to think about timing. And again, for me, I like to trade sentiment a lot. And when I see everybody and his dog howling about inflation, I'm inclined to say, okay, this thing's a little overdone, and I'll make a bet going the other way.
During our interview in January this year, you told us the U.S. dollar had a cathartic inflection point when the mob stormed the Capitol building on January 6th. You thought the U.S. dollar would rally, and you've maintained a bullish stance on the U.S. dollar during every interview we've done this year. Has that view changed?
Short answer is no. I remain bullish of the U.S. dollar relative to other currencies. And I was just making that point about, people realize that currency doesn't buy as much stuff as it used to. Yeah, the U.S. dollar is going down in terms of furniture, in terms of food, and so on, but it's certainly not going down in terms of the Japanese yen or the euro. So people, you really have to keep that clear in your mind. I understand when people say things like the U.S. dollar isn't worth the paper it's printed on. I understand that, and I know why you're saying that. But when I'm trading currencies, that's not part of the issue. What is the issue is, what's it like relative to the yen or the peso or what have you? And it was a cathartic inflection point, and it wasn't so much like inspiration of mine at the time. I just saw it, and I remember watching the 6 o'clock news and seeing this mob tear into, the shining house on the hill in terms of democracy in the world and all that. And I thought, man, people all around the world are seeing this. This is dreadful. And then it occurred to me as a trader, you just go, oh, but if that's the case, then, like that. Yeah, or it was the old Rothschild thing about, you want to buy the market when there's blood running in the streets, or some expression of that, like that. So yes, in January the 6th is when the mob went into the Capitol building. That was a 3-year low on the U.S. dollar, and it has been nothing but higher since. Speaking of those other currencies, from that date until now, the Japanese yen is down about 10%. The Japanese yen real close to a 5-year low against the U.S. dollar. The euro currency is down 8% or so since early June. And here's one that and this might be a little esoteric for some of our listeners, but other people might get a kick out of this. One of the things I watch is the euro relative to the Swiss franc. And the euro right now is like within a hair of all-time lows against the Swiss franc. And why I pay attention to this is I kind of see that relationship like this. Now picture you are a German citizen, and you're looking around you and you don't like the way things are going, politically and COVID and, socialism, whatever. You're going to take some of your money and slip across the border and put it in Switzerland where you think it's going to be safe. So I kind of look at the euro Swiss franc spread as a barometer of that kind of thinking. Now, we just went through a thing here where it looked like maybe the Europeans were going to freeze to death in the dark this winter because Russia wasn't going to sell them enough natural gas. Again, you're that German citizen and you think, the clowns running this show haven't got any idea. I'm putting some of my money in Switzerland where at least I'll have something if these guys just, make a total mess of things. So, currencies, the U.S. dollar, again, against furniture or against food, the U.S. dollar is going down. But against the euro, the Japanese yen, actually most of the currencies in the world, the U.S. dollar has been rising this year, and that's how it's been going.
The Canadian dollar seems to be one of the few widely traded currencies that has not weakened against the U.S. dollar this year. Is that because of the strong commodity market?
I think that's a big part of it. And for instance, the Canadian dollar made its high for the year back at the beginning of June. We were at 83 cents, and then it's come off a bit since then. I think, we're around 79 cents now. So that slide of 4 cents has brought us back to just about where we were at the beginning of the year. So let's say the Canada's a break even year to date where, these other currencies are lower. And that slide since the beginning of June, I think, was, even though commodities had helped the Canadian dollar, what were we, 68 cents or something at the lows in March of last year, the boom in commodities up over 100% in that period of time, the broad commodity indices, I should say, certainly helped take the Canadian dollar up. The decline in the Canadian dollar since June, I think, has been more a case of the U.S. dollar's been strong in that period of time against everything I was just mentioning. The euro's down 8% in that period of time. Canada, obviously, much less. But over time, I've seen that, and we talked about this before, but over time, the most important thing that determines the value of the Canadian dollar is the strength or weakness of the U.S. dollar against all of the currencies. Also, over time, and by that I mean if you put a chart, a 20-year chart of the commodity market indices and the Canadian dollar up on the wall and looked at it, they're virtually identical. So the commodity market is, if it's going down, the Canadian dollar is going down. Okay. And usually, by the way, if the commodity market's going down, that's because the U.S. dollar is going up. There are these interrelationships in the markets that I pay a lot of attention to. Lately, the last 18 months or so, a rising stock market has also been very good for the Canadian dollar. And when we say commodities, the crude oil, especially, we were negative prices on crude oil very briefly in April of last year. But let's say, the low was really around $20 and we rallied all the way to $85. And on that rally, people maybe thought that it was just going to keep going and going and going. So that was very supportive of the Canadian. And, one thing very, very short term here, I'm a little surprised, and that is that the Canadian dollar has not reacted very strongly, if at all, to the troubles that we've had here in Western Canada with all the flooding that's shutting down transportation of goods and fuel and so on. So, if you're a tech corporation and you're mining coking coal and you're trying to ship it out of the port here, and, that earns income for Canada, well, that's not moving, or at least, there's a good chance that's, if they've got some left there, they can load it on the boats, but then if they can't train any more in from the coal mine, then, that's going to have an impact on the revenue we receive from selling stuff to other countries. At the same time, we got ships, everybody knows about the ships lined up outside Los Angeles. Well, I could see a situation where the ships are going to be parked in the harbor in Vancouver waiting to unload stuff that ought to be loaded onto a train and sent across the country. So that's not happening. So far, the Canadian dollar doesn't seem to have reacted to the problems here that we have in Western Canada. We'll see if that changes in the next week or two. I guess the thing will depend on whether or not the infrastructure can get repaired and we can sort of get back to business as usual pretty quickly. Then it'll be transitory, to use that word. If not, then it might put some pressure on the Canadian dollar.
Gold made its high for the year in January and dropped as much as $250 from those highs. You've often explained that gold is often the mirror image of the U.S. dollar. Is the stronger U.S. dollar this year the reason for gold not doing better?
Yeah, I think it's a big part of it. I mean, these correlations, sometimes they'll be tight and sometimes, they just don't work. For instance, I mean, the last 2 weeks, gold and the U.S. dollar were both up together. And gold, you're right, gold made its high for this year the first week of January. That was the same week the U.S. dollar made its low. And on balance, the U.S. dollar has traded higher since then, and until the past couple of weeks here, gold kind of traded lower. So that was certainly a part of it. Another one of the things that really impacts gold is the level of negative interest rates or the negative real interest rates especially. And we saw alerts higher actually it's alerts lower as rates became more negative. And I think that was one of the reasons that gold popped here about over $100, I guess, in the previous 2 weeks, as the inflation rising being the denominator, I guess, in the equation of real interest rates. Higher inflation meant that the real interest rates got deeper negative, and that gave gold a lift. As I mentioned earlier, in terms of the inflation story now being on page one, and that makes me a little inclined to think maybe it's overdone. I took a short position in gold after it had rallied $100. Now, again, I don't just short it because I thought, it's gone too far, you can poke it in the eye. No. I thought, it's gone too far, I should look for an opportunity to get short gold if it presents itself. And for me, the opportunity would be, okay, it really does look as though it's run out of steam to the downside. It's starting to trickle a little lower. Some of the people that jumped into that and got $100 on the move up are going to get nervous and think, okay, that's it. Maybe I should sell. People that might have been thinking of buying are going to hold off because it looks weak and the price drops a bit, and I can make a profit on that. I'm not shorting gold here, and going to hold that position and for the next year or two or whatever. Just a short-term trade.
Crude has been a big part of the commodity rally over the last 18 months, but lately it seems to have hit a wall at around $85. Do you think we've seen the high for the year?
Well, let's see. How much we got left in the year? About 7. No, it's not even that much. It's just over 5 weeks, I guess. Yeah, I think I'd say that. I don't think we'll see WTI, front month WTI, trade over $85, trade above $85 this year. I remember we were talking a couple of months ago, and I said something to the effect of, I think if oil, you asked me if I thought oil could get to $100 this year, and I said no. And my thinking there is that, high prices really do crimp demand. That's just how it works. Now, there are some people that'll just buy it because they have to, but other people will start making different plans, and, that's the way it works. I talked about $50 a pound tenderloin. Well, a lot of people say, something, I think I'll just buy the hamburger. So higher prices do have an impact. We had crude run, where were we? We were about $62 in August, and it ran up to $85. And I think a good part of that was what we called the reopening idea. Okay, COVID's behind us. We can step up. People are going to start flying again, traveling again. The borders will be open. There'll be demand for things. Trucks are going to be using a lot of fuel. And, everybody knows there's been a real cutback on capital or CapEx in the oil patch. So, supply is going to be down, and it's just a wonderful world to speculate on the long side of crude. So there was a buying in anticipation of an increase in demand. And I'm not going to try to pretend I'm an expert on crude, but I would say there's also this other factor where we kind of know how much oil around the world could get pumped if everybody put their shoulder to the wheel and went max, okay? And that number is maybe, let's call it, maybe 103 million barrels a day. And, even these days, let's say demand is 100 million barrels a day, just for perspective. And if the economy really did start to boom, we could easily consume another 3 million barrels a day. And then all of a sudden you're at a position where, holy mackerel, supply is really tight. I mean, if anything goes haywire anywhere, some pipeline doesn't work or somebody drops a bomb in the wrong place or whatever, you could have the crude oil prices explode higher. And, a lot of people that are really want to be bullish about crude, are very aware of that kind of thing. So longer term, I can see crude oil prices going higher. I could see them going a lot higher. We're trying to make this transition from a fossil fuel world to not that anymore. We're going to have EVs and we're going to have windmills and whatnot. I think there's a lot of institutional money, pension funds, that are saying we don't want to have anything to do with investing money in oil and gas companies, and we're going to sell our shares. And the oil and gas companies are maybe being pressured to pay out more dividends or do share buybacks instead of putting the money into drilling. I mean, let's say the timeline from when you first drill a hole till you start to get paid back from that is anywhere from, if you're in the shale patch, maybe it's less than a year, but, a lot of traditional stuff, that's multi-years. And you're looking out multi-years and you think, hey, by the time we bring this well on stream, there may be a law against burning crude oil or gasoline or what have you. So why bother? Let's not do it. So I could see there's a very bullish argument longer term for crude. But here in the short term, we've had that run from $62 in August to $85. We backed up to maybe $75, and I think part of that is maybe a reassessment as to whether the immediate demand is as strong as it is. And then, crude oil traders out of the corner of their eye, they're paying attention to things like you've just had a hard lockdown in Austria, COVID. You got COVID numbers that are going up in Europe, also going up here in North America. And you have to think, okay, do I want to pay the highest prices that crude has been in years and take the chance that, COVID's going to shut down or cool the economy? I don't think so. So we back the market up a little bit from those $85 highs.
One of the old sayings around the markets is that there's nothing new under the sun, meaning this time is not different, that markets change, but people don't. They're still driven by fear and greed just like they've been for centuries. So what do you think about that, and does that have any bearing on how you trade right now?
It really does. I guess I would start with, I know I don't know hardly a thing. And if I ever meet anybody, and over the years I have met a number of people in this business who are arrogant, I just automatically assume they're ignorant, like they just have no idea of the facts. Because if you knew, a fraction of the facts, how could you possibly, assume that you knew what was going on? So there's just so many things, issues, whatever, that impact the prices of things. I don't pretend I know them. Now, I will do a lot of research. I read constantly. I'm looking at videos and podcasts and all that kind of thing, and I've been doing this for 50 years. But probably at the base level, I form some kind of, let's call it a bias as opposed to an opinion, okay? I've got a bias that, the U.S. dollar is going higher. I know it doesn't go higher every day, and I also know I could just be dead wrong. This might be the high, and it is going to go the other way. But I'll form a bias, and then I'm going to kind of watch to see, what the crowd is doing. Whereas I said earlier that momentum trumps valuation, and I understand valuation. You could say, you come home with something you bought when you were a kid, and your mother says, "How much did you pay for that? Are you crazy?" Well, the same thing, that's kind of like valuations in the stock market. Do you want to buy this thing here and you're going to own this thing for the next 10 years? Oh, hell no. I'm just going to own it for 10 minutes. Well, that's a different story. I've got this bias. I'm going to watch for what the crowd is doing. And like I just described in gold, the crowd jumped in there, drove the gold price up $100. It had been like a sleeping dog, and all of a sudden it's excited and it runs up $100. And then sort of runs out of steam. Well, for me, that's an opportunity on a short-term trading basis, gauging sentiment in the market to be short. Now, I have written in my blog many times, and I'm very candid in my blog. I talk about my losing trades and my winning trades. And I've had this idea that the markets have changed, that, this time really is different in this sense. And I'll credit Raoul Pal, who started Real Vision TV. And I was watching an interview he did this week, and something he said really rang true with me. He said, there's been a regime change, and he's talking demographics here. I don't know if you know it, but there are now more millennials in the world than there are baby boomers. And the baby boomers are certainly retiring from trading or actively managing their money or just plain dying off. And the millennials are different. According to Raoul, and he's closer to millennial age than I am, although he's not one himself, he says they're inclined to take much more risk. In a way, they've got nothing to lose, so shoot for the stars or whatever. And I have wondered in my blog if some of the what I call old school metrics or old school way of looking at the market that I have, it doesn't work anymore, or at least I have the sense that I'm out of sync at times. And that's not just, I put on a losing trade and, therefore my methods don't work anymore. No, it's more than that. It's this idea that markets have changed. I mean, you certainly see some of these, let's say the options market. There has been an extraordinary, almost a tidal wave of buying going into some single stock options. It's bizarre. You've heard of some of these meme stocks that have gone from, $5 to $500, and maybe Tesla's one, who knows. But you see some of this extraordinary volatility in markets and say, wow. When I look at a market, the first thing I'm looking at is what's my risk. It would seem from what Raoul is saying that the millennials think, how much money can I make on this? Now, maybe when they get to be my age, they'll be thinking my way, because I know when I was in my 30s, I was way more aggressive in the trading that I did. But as time went by, I saw a lot of the guys that were around me just kind of fell by the wayside. They weren't there anymore. Took too much risk, and they got carried out. So, in that sense, Jimmy, I'm going to come back to what you said. It's like there's nothing new under the sun, or to everything there is a season, that sort of stuff. Yeah. Markets change, but people don't. People still will get greedy and think that they're right and jump in, and after they've been burned a few times, maybe they get a little more cautious. But we've got a whole new wave of millennials that are involved in the markets that I trade, and they have changed the complexion of, let's call it the rate of change as to how things move. And in that sense, this time is different.
Well, don't forget, too, if you're 40 or 35 years old, you got lots of time to recover your losses. When you're 67, you don't.
Yep, that's right.
Victor, thank you so much for being on This Week in Money.
Jim, as I say, it's always a pleasure to talk with you. Thank you kindly for having me on.
My guest has been Victor Adair, just recently retired from nearly 50 years of being in the brokerage business in BC. Check out his website, victoradair.ca. Coming up, John Rubino, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. He's speaking to us from near Port Angeles, Washington State. John, welcome back to This Week in Money.
Hey, Jim. How are you today?
Well, we're doing great. I live in New Westminster, near Vancouver, overlooking the Fraser River, which just a couple of miles east of me has flooded and taken out much of the town of Abbotsford. Vancouver doesn't have any road or rail access to the rest of Canada right now. That's all washed out. But where I am living personally, just the end of my street got flooded. I'm eight floors up, so if it comes for me, I do actually have a life ring on the balcony. It's a decoration, but I guess I could use it if I had to. That's what's going on here in Vancouver.
Yeah, I caught the tail end of that down here. That was quite a rainstorm. Hopefully that's it for the year.
John, does it look like the Fed is losing control of the inflation narrative?
Yeah, Jim, it really does. They've been telling us for a year that the inflation that we're seeing is temporary, to be expected as we rebound from the pandemic lockdowns and soon to go away. But it's not going away. Prices are accelerating in a lot of different markets. You know, now down here we have Thanksgiving this month, which is traditionally a time when so people can track what it costs from year to year. And apparently this year it's way more expensive. So that's another thing that people are going to notice as part of their daily lives get more and more expensive. But, you know, it's already happening. Gas is way up and heating oil is up and coffee has doubled in the last year. And it pretty much just goes on and on across the economy now as big increases in industrial commodities work their way through to consumer goods. So I think more and more people are coming to the conclusion that we're actually in an inflationary environment now. And the fact that the Fed didn't think this could happen just adds more or detracts more from their credibility. They already weren't that credible, and now I think a broader number of people in the U.S. at least are starting to see these guys for the morons that most of them are. You know, they've been so consistently wrong about virtually everything they've done for such a long time that people in the sound money community, you know, the gold bugs of the world and the value investors out there, to the extent that any of them are left, you know, we all see, or we have seen for a long time, that the Fed just didn't know what it was talking about. And I think the broader public is now coming to that conclusion. And that's a very dangerous thing in a fiat currency world, because these currencies only exist because we trust the people managing them. They don't have any intrinsic value in and of themselves. So you take that confidence in those people away, and the value of these currencies will just evaporate. So we're heading in that direction at an accelerating rate.
Mm-hmm. Well, good friend of the show, Tim Cyclesman Wood, in an interview I did with him on Thursday, said since 2009 under Obama, and then President Trump, and then President Biden, with the infrastructure bill added with this and all these other relief packages, U.S. government debt since 2009 has gone up $7.6 trillion. That's a penny or two. And, of course, at some point, they'll want that money paid back.
Yeah, at some point, we do have to pay that back. And see, here's the really scary thing about all of this is inflation goes up. It usually makes interest rates go up, because an interest rate is just what you get paid when you lend money, right? And if you're going to get paid back in cheaper and cheaper currency, you want a higher and higher rate to make it worth your while. So if interest rates go up and we have this mountain of debt out there that has to be rolled over and or paid off, the cost of managing that debt goes up commensurately. And just take U.S. interest rates back to their normal levels historically, we're bankrupt. And take global interest rates back to their normal levels, and many, many other governments are also bankrupt. So, you know, the conclusion is that we either raise interest rates and go bankrupt, or never raise interest rates again for the rest of history. So that's what we're staring at now. And again, as people figure this out, they're going to be terrified and they're going to act accordingly. And we have the potential for a financial system that just spins out of control.
What's going on with the labor market?
Well, this is another big component to the inflation story, because The Fed in the U.S. does not care if stocks, bonds, and real estate go up in value. And that's what we've had for the last 20 years. That's been our inflation. It's been in financial assets mostly held by rich people. And the Fed is fine with that. But as soon as regular people start making more money on their jobs, the Fed gets scared. They call that wage inflation, and that's one of the indicators that is most likely to convince them to start tightening and raising interest rates again. And boy, are we seeing wage inflation down here. Pretty much every business is having trouble finding enough employees. Many of those businesses are starting to raise wages. They're also doing other things, like doing away with the requirement for a college education for new employees, and doing away with drug tests and things like that, and they're hiring people on the spot. Like a 10-minute phone call can get you hired in a lot of places now, whereas in the past you had to go for weeks of interviews and, resume presentations and things like that. But the fact that they're raising salaries dramatically means that wage inflation is going to be a real thing. It's going to be a number that is published in headlines going forward. And it's possible that spooks the Fed. It's possible that spooks the bond markets. And it's possible that it causes kind of a ratcheting up of inflation going forward, because people, they'll get bigger paychecks, but they'll see those paychecks being eroded at the same time by rising prices, and they're liable to panic buy everything they're going to need in the year ahead right away if they can do it, and that forces prices up in the moment, which starts the whole cycle over again. So we're in danger of that kind of a death spiral-ish feedback loop starting with no real way of stopping it.
Yes. Now, an example of what's going on with labor in Vancouver, a popular small restaurant couldn't find a dishwasher, and they put that job up for $50,000 a year, $25 an hour, and they still had trouble filling it. And then when people heard about it, of course, they got hundreds of phone calls, but it was too late. In the U.S., Mike Swanson, again a friend of the show, pointed out the U.S. has seen its third highest number of strikes ever. Perhaps the most notorious, John Deere workers turned down a contract offer of 10% this year and 5% in the next 2 years. They have just settled, but we haven't heard about the terms there. So, a lot of price inflation, but isn't it interesting when the regular guy starts asking for money, then the government pays attention?
Yeah, it is interesting. They by the way, they just settled the Deere strike.
Yes.
And the terms were similar to what you said but with a signing bonus too. They have a retention bonus of like $8,000 for a lot of their people now.
Oh my God, so, I gotta work there.
Yeah. So it's a big upfront bump. They don't have a lot of, they have cost of living increases, but not otherwise big built-in raises going forward. But right now they're going to get a 10% raise right away, and then a signing bonus. So it's immediate wage inflation at Deere. And, if the workers aren't happy in a couple of years, they'll just go back, they'll strike again because they know they can do it, and they know they can get some results from it. And that is kind of spreading across the country as businesses get more desperate, workers get more bold. And that's part of the wage spiral that we're liable to see here, where workers know they've got their businesses, they've got their employees kind of over a barrel here, and they're going to demand as much as they can get, which is their right, because the aristocracy has been bleeding the peasants dry for the last 20 or 30 years, and it's time the power balance shifted a bit back in favor of regular people.
We're told the supply chain problem is partially caused by a shortage of truck drivers, but I wouldn't want to take a costly truck driving program to get my truck driver's license to find out that I'm replaced in a robot in 2 or 3 years, and that's what they're predicting. Robots are going to take over interstate trucking in just a few years. So why become a truck driver?
Yeah, you can make great money right now. And get a big signing bonus and whatever perks are available for truck drivers. But yeah, you're right. It's a really short-term gig, and because of that, the population of truck drivers is kind of aging out. They skew really older now because a lot of young people don't want to do this for the reasons that you're talking about. And until we do have self-driving trucks, the businesses of the world have no choice but to pay whatever it takes to get their stuff moved from place to place, because otherwise they don't even have a business anymore if they can't ship their goods from the factory to the stores. So they just have to pay up. And, that's sort of the rest of the economy in microcosm right there, where there just aren't enough people. And not staffing a business is not an option, because then the business ceases to exist. So you have to pay whatever you have to pay. And then you have to pass those extra costs on to your consumers or to your customers. And then they have to pay it. So, yeah, we're looking at substantially higher inflation, certainly in the short run and probably going forward.
Is U.S. housing officially in a bubble, and is this concerning?
This is a fascinating part of the U.S. economy right now, because normally the way bubbles work is that you don't get the same bubble repeating in successive expansions, because normally people they remember the bubble bursting last time around, so they don't want to be burned again, so they avoid the bubble asset. And you have to have a few cycles before the same thing can be in bubble again. But with housing, we are absolutely in a bubble. And, it's not just because of high prices. High prices aren't the only criteria for a bubble. You also have to have behaviors change in the industry in a way that is really dysfunctional. In other words, people start throwing out tried and tested business practices in favor of whatever it takes to get the deal done. And that's what's happening in the housing market. Just a few quick stats right now. The time on the market for a typical U.S. house is down to 1 week. It used to be that, you expected to have your house on the market for weeks and possibly months, because you had to find just the right buyer to come along and pay your price. It's not that way anymore. They'll buy any house out there. And part of that is Wall Street is buying up houses like crazy to turn them into rentals, which is a whole separate horrendous thing that's happening. But that's driving up prices and taking houses off the market right away. At the same time, the average asking price for a U.S. house is now identical to the average selling price, which doesn't normally happen. Usually you ask for more than you get, right? And you expect, when you set your asking price, to have to negotiate downward a bit in order to get the deal done. Not the case anymore. Whatever you ask for, you probably get, and sometimes you get considerably more. And the final thing, and the most scary thing of all of this, is that in order to get deals done, buyers are having to agree to waive the right to back out of the deal if the appraisal comes in really low or if the inspection finds major problems. It used to be you could walk away if something like that happened. Now, a lot of these guys can't anymore, because if they don't agree to waive their rights with regard to appraisal and inspection, somebody else will just come along and do that and take the house away from you. So there are a lot of people who are, they're on the hook now for it's sort of a as-is, no warranty kind of situation, where you're buying it and all of its problems, and it doesn't matter if you find out about those problems before you sign. You still have to sign, And that is something that only happens in a bubble market. And so we're there, Real estate is a very big part of the U.S. economy. Massive amounts of debts are being taken on in the process of buying houses and taking out home equity loans on them and everything. And those houses are wildly overvalued. So we're going to see, at some point there will be a bust. Houses will tank, and millions of people will lose their houses again because of this market.
This month, there were elections in the states of Virginia and New Jersey. What were the results, and could these elections be indicators of what's ahead?
It's a very big deal, which you wouldn't normally think that an off-year election in a mid-sized state like Jersey or Virginia would, be earth-shattering for the big political parties in the U.S. But that's the case this time around, because the Democrats were supposed to just walk to victory in both of those states. They're both, very, very Democrat states, very liberal in their voting patterns. But this time around, the Republicans crushed the Democrats in Virginia, and they almost won the governorship in New Jersey, which would have been, an astounding outcome. But they came really close to doing that. And the reason for that is that the Democrats in the U.S. took power and then really, really overplayed their hand this time around. I mean, they're locking down businesses and closing schools, and they're teaching a lot of things in the schools that parents find abhorrent or at least very disturbing. And because of all that, and they're not backing off on any of that, so because of all that, when our congressional midterm elections happen next year at this time, if today's polls were maintained all the way till then, the Republicans would take back the Senate and take back Congress, and you'd have a very divided government in the U.S. With a really weakened presidency and emboldened legislature, which means very little would get done probably. So we'd be back in gridlock at a time when we've got a lot of problems that need to be fixed one way or another, and we won't be able to do it. So that's a highly possible outcome right now. And as messy as U.S. politics are now, they might be a lot messier then, and we might be a lot more ineffectual, unable to really get anything done, no matter what kind of a crisis out there needs our attention. So, by and large, it's entertaining, but it's potentially a really bad thing just because hamstrung government is an ineffectual government and a government that's unable to address problems as they come up.
The price of gold, where could it go from here?
Well, it's been kind of creeping back up to the high middle part of the range that it's been in for a really long time, and that's boring on the one hand, but just fine on the other hand for the gold miners because it's at a level where they make good money. So the gold miners are generating lots of free cash flow. They're a very healthy industry right now, and that's a good thing for investors in that sector. Now, if inflation keeps rising and more people begin noticing, so that the general psychological state of U.S. consumers and investors is that we are in an inflationary environment, that's really good for gold and silver. So you would think that they would rocket from here if current trends continue. And I'm not saying I expect that. I mean, I expect them to do that eventually. But I don't know whether that's like a 6-month out thing or 5 years out. But I think that the world that we have created is paradise for inflation hedge / safe haven assets like gold and silver. So I think they're going to do great. I don't know when, but it's completely possible that in the next year, given the political stuff we're talking about and all the other trends, that gold and silver really start to ramp up, and you see record highs for both of them in the coming year.
Mm-hmm. Are mining mergers and acquisitions a good sign for the mining industry? Or markets?
Yeah, well, they're a sign of things that have to happen in the mining industry, because the big gold miners and big silver miners are taking more metal out of the ground than they're finding with their own exploration programs, which means they got to get reserves from somewhere. And at the same time, they're generating free cash flow, which means they have the wherewithal to go out and buy up smaller miners in order to get those reserves. So it's a good thing for the little guys because, if you're a small miner and you have a pretty good, pretty solid, pretty well-defined property that has enough gold or silver to move the needle for a bigger miner, then they're going to be looking at you hard, and they're going to be wondering how much they have to pay to get you. And as this process goes on, the premiums will rise. Big guys will have to pay more and more to buy out the little guys. And so the people who hang in there with the small miners are going to see really nice improvements in their investments going forward, I think.
What do you see ahead for the battery metals?
Well, it looks like that every major government in the world has made the decision to transition away from fossil fuels and towards an electric economy. In other words, electric cars, solar power generating the electricity that charges those electric car batteries. And to do that, we need way more copper and nickel and zinc and cobalt and lithium than we have now. The world's mines aren't producing anywhere near enough of those metals to satisfy the goals of the major world governments, who seem to be pretty serious about this whole thing. So that means, one, the price of those things have to go up, and two, the prices have to go up enough to incent the miners to go out there and find new reserves and bring them on the market as soon as possible. Copper, for instance, we need so much copper to electrify the world that it's really not clear where we would get it, just because we've been mining copper for 200 years. And the easy deposits have been found, the cheap deposits have been found. So now what's left is much dicier. It's more expensive to get at, it's in harder places, and you need a much higher price in order to make it worthwhile for a miner to go get some of the copper deposits that are left. So I think, copper, which is way less sexy than gold and silver, but it's probably a safer bet, all things considered. And the same thing with the other battery metals. There really doesn't seem to be an alternative to going out and finding more of these things, and you need a higher price for that to be viable for a lot of miners. So yeah, I think the battery metals, a nice diversified portfolio of battery metals would probably do just great in the next 5 or so years.
John, where can people follow you and find out more information about dollarcollapse.com?
Well, I run dollarcollapse.com, and it's a site that talks about all of this stuff, kind of updated continuously. So come on over and join the email list by clicking on the button at the top of the site, and I'll just send you whatever I write for free going forward.
John, thank you so much for being on This Week in Money.
Thanks, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. He was speaking to us from Washington State near beautiful Port Angeles. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and John Rubino. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese CEO Larry Reaugh. I'm Jim Goddard. I'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to Company Showcase, Larry.
Thank you.
Larry, again, another very busy week at American Manganese. What are you working on right now?
Oh, well, a lot of conference calls are being made, and more contacts are coming in. Unfortunately, they're under NDA, which is fine. The reality of the whole situation is when we get the demonstration plant up and running, we can come with some solid numbers on what it's going to cost us to produce the cathode material at the end of the recycling process, and and what our operation costs are going to be, what our build out costs are going to be. We can have all those things with this. I'm really looking forward to getting this started. And it's a little late in the year now to think about starting up before Christmas, but I'm hoping that we'll have all the pieces in and be able to start soon after. And it's going to be another milestone for the company. Now we can start putting numbers around things that I don't know how other people are doing, but you're seeing all kinds of distractions in the market. And some of those distractions are, still talking about the unprofitability of lithium-ion batteries and recycling lithium-ion batteries, I should say. And, as far as I can see, even from the back of the envelope for what we're doing right now, that couldn't be further from the truth. Let's see, the title in the Sun-Times is, Will Electric Vehicle Battery Recycling Actually Be Economical? Well, that is a good question. And, certainly when you look at all the processes, if some journalist does a deep dive, he's beginning to wonder if it could be, if there could be a profit at the end of the day. We think that there is. I mean, ever since we started down this path, we've been keeping track on the, what I always call on the back of the envelope, I guess you'd call it back of the envelope projections. And the projections are that, yes, we think we can make a profit. We've only optimized on that through everything that we've done. And it would be nice to have those numbers, provided by the demonstration plant. And I think that'll change the whole shift on what people are thinking about on recycling. So, and what a lot of companies are not really facing up to is the fact that there's still pollution being introduced into the environment. And we want to keep that out of the environment. So, hence our work with scraps. And we should have, reuse of water. We should have the product at the end of the day getting close to 100% recoveries. And very little, if any, waste material. So that, is something we've strived for from the very beginning. And now it's starting to show itself as being an important aspect of recycling. And so I feel good about everything, Jim. It's going on that way. There's other articles out there like, Tesla saying they're going to go to iron phosphate, lithium-ion phosphate batteries. They have no value. And they're heavy. And so you won't get the mileage out of them. And they're just not recyclable unless you want to go into a cost-plus situation where somebody can recycle that material and, bury it somewhere, the waste material, and, get the graphite and the metals out. Now, there's no value in resale of those metals, so the only thing that has value is lithium, and that's a very small portion of a lithium iron phosphate battery. So that's not going to carry any weight. So I've included an article in here by a Korean group that pretty much, says it the way it is, and that is that you're not going to make any money. You're not going to be able to recycle those batteries with a profit. So, if anything, it's going to cost you more at the end of the day than putting in a nickel manganese cobalt battery, for example. Because that is recyclable, and you can get, we can get 100% of the valuable metals back and put into a new battery. So, these are things that work in our favor. Maybe they look like they're coming from offside and they're not favorable, but people want to look at our transparency. They'll see that that's exactly what we've been working for the last few years. And so, getting this demonstration plant up and going is critical for us to start out or into the new year and, have some numbers to build a commercial plant around. So, that's a very interesting thing. There's other articles out there where trains are going to start using lithium-ion batteries for power. And that it goes a long ways. There's airplanes that are being developed to do that. There's ships that are being developed to do that. One of the major ones here is right in the Vancouver area. And cars, trucks, off-road vehicles, underground vehicles, mining. Some companies have already gone 100% lithium-ion. So the usage for lithium-ion batteries is going to go through the roof. And certainly the electric vehicle is going to be the leader in all that. So I see nothing but good times coming for the company. And I have articles attached to this podcast that speak to some of these things that I just talked about. And I think we got a clear path forward. You know, we've got money in the bank, enough money in the bank to see a clear path to commercial production. And so, you know, we've de-risked everything. Now the last de-risking is the demonstration plant. And so that's going to be a big feather in our cap, because that'll just be the climax of all the work that we've done to date. And so, Jim, it's been a hectic week. You know, my birthday fell in the middle of this week, and so you know, it's been I got a lot of good wishes, and so it's something that we're just going to carry forward with our work, and I put my birthday behind me. I never think much about my birthday, but a lot of other people do, especially family. And so anyway, you know, I had a nice dinner. So what can I say?
For our new listeners, what's American Manganese all about, Larry?
American Manganese is a critical metals company that developed a process for treatment of low grades of manganese in the U.S. And the U.S. has manganese deposits, but they're all low grades. And we developed a process that's patented, and we can turn around the 2 to 3% material, which is garbage in most of the manganese mines in the world, and turn that into valuable commodities. And that is the cornerstone of our recycling. It just so happened that fit perfectly. And so, you know, we had a jump on that, and certainly our major push the first couple of years was to get those patents approved and get them written and get them in and do the work that was necessary to prove that we could do what we said we were going to do. And those patents will be ultimately important, and you know, they are important now, but people don't see the value in that. They think, oh, well, proprietary is just as good as patented, but you can certainly protect your patented process, where propriety is going to be a sticky wicket to try to protect. So, you know, you don't know how many companies are using proprietary methodology that overlaps and would never make it through a patent application. But we got our patents. We did our proof of concept work, and we've done nothing but work ever since to achieve environmentally friendly closed loop solution for recycling batteries, and we've gotten there. Now you can we've reported on every step of our way in our press releases that are on our website, AmericanManganeseInc.com, and you can go there and find out every step that the company has taken. And you know, I may do an accumulation of the major steps since we started this process the next maybe before Christmas, you know, on so that people can look at it and you know, and read through it in 3 or 4 minutes and see exactly what the company's done. So we're traded on the Toronto Venture Exchange under the symbol AMY. We're traded on the US QB board under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM. And you can phone the company here at 778-574-4444, or you can send me an email at LREAUGH@AMYMN.com.
Larry, thank you so much for the update, and happy birthday.
Thanks, Jim.
My guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on November 19th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.